Hello, my name is Yousuf Ahmed. I'm here for my Go See It project. This is my family member, Yousuf Ahmed, who owns his own accounting firm, and today he's going to talk about how he generates financial statements from the given source documents that his clients give him.
Thank you, Yousuf. So what we go ahead and do at our accounting firm is we create financial statements using an accounting software called QuickBooks, primarily. So on a monthly basis, I have many of our clients that will go ahead and deliver source documents to our office. These source documents will include bank statements, bills, receipts, invoices, deposits, sales receipts, right? So we usually have 3 separate people that touch all the paperwork before they actually get to the financial statements and get it over to the client.
Okay.
The first person is called a staff accountant, right? A junior level accountant. They'll go ahead and take all the source documents and enter all the data, the bills, the invoices, the receipts, into the accounting software QuickBooks.
Right.
Once he's done all the data entry and everything's done from his end, he passes on all the source documents and the bank statements to the next accountant, which is usually a senior accountant.
Okay.
At this time, the senior accountant's main responsibility is twofold. The first, to go ahead and review what the junior accountant's done.
Right.
Second is to go ahead and reconcile the bank statements. When I say reconcile the bank statements, he has to reconcile the physical bank statement from Bank of America to the check register in the accounting software QuickBooks. Right? Sometimes there may be deposits and transits, there may be outstanding checks, whatever they are, whatever issues, he needs to make sure that the bank balance and the book register are in sync.
Right.
Once they're in sync, then it comes to me as a manager. My job is to go ahead and publish the financial statements. In order for me to publish the financial statements, I need to go ahead and first review the financial statements and make some adjusting journal entries. The 2 adjusting journal entries that we make on a monthly basis for almost all of our clients, first one is recording depreciation on a monthly basis. Right? Many of our clients will go ahead and use straight line depreciation method because that's the easiest way to go ahead and do it. Second is recording in another adjusting journal entry for allowance for doubtful accounts. Right? Every client has it differently. What we go ahead and do for most of our clients, anything that's over 180 days old,
6 months.
6 months,
Right.
We run an AR aging report, accounts receivable aging report, and take whatever balance is off 6 months or greater, and take 20 or 25% and just make an adjustment to write that off as an allowance for doubtful account. So we debit bad debt, we credit allowance for doubtful account as a contra asset. Right? Once that's done, then I'll go ahead and review the financial statements. There are 3 reports that I review primarily. First one's my trial balance to make sure my debits and credits and everything else looks good on there. Second is I'll run a balance sheet. We'll review my assets, my liabilities, my equity, and I'll run an income statement to look at my income and expenses. If everything makes sense, then our job is done and we go ahead and publish the financial statements to the client.
And sometimes the client will come back.
Once in a while, the client will come back and ask us to go ahead and make some more adjustments. But usually, they're pretty good. And that takes you over the entire life cycle of an accountant.
All right. Thank you, Yousuf.
Not a problem. Thanks for having me.
Yep. This was my Go See It project about how we generate financial statements from given source documents that